On Friday, I told you the dollar was setting up for a crash up. Today is Monday. The US dollar index just hit 101, a 13-month high, up nearly 2% in the last month alone. And I know what you're thinking. If the dollar is getting stronger, isn't that good? Doesn't that mean my savings are worth more? No. And by the end of this video, I'm going to show you why the dollar getting stronger right now is actually one of the most important signals gold has given us in years. Because there's a pattern buried in the data that almost nobody in the financial media is connecting. The same conditions that are pushing the dollar higher right now are quietly building the most constructive setup for gold we've seen since 2019. I'm going to show you the exact signals, 7 of them, and I'm going to put the data on screen so you can see it yourself. And at the end, I'm going to tell you what would change my mind. Because this channel only works if I'm honest about both sides. Stay with me. Quick thing before we get into it. I spent 17 years in the mortgage business, May 2007 through December 2024. Before that, I was a finance manager for Larry Van Tile, before he sold to Berkshire Hathaway. So I've been in finance since 2003. I'm telling you that because what I'm about to show you isn't theory. The yield curve signal I'm going to walk you through, I watched it happen from the inside in 2007 and 2008. I sat across from clients while the credit market tightened around them in real time. I saw what happens when the curve inverts and banks stop lending. What's happening right now is rhyming with that pattern. Not identical, but rhyming. And if you have money in a savings account, a 401k, or you're sitting on home equity wondering what to do, this matters more than almost anything else you'll see this week. Let's start with what just happened. Last Wednesday, Kevin Warsh held his first FOMC press conference as Fed chair. The Fed held rates at 3.5 to 3.75%. That was expected. What wasn't expected, at least not by most of the financial media, was the tone. 9 of 19 Fed policymakers now see at least one rate hike before the end of the year. Not a cut, a hike. While CPI is running at 4.2%. The Fed revised their own inflation forecast from 2.7% to 3.6% in 90 days. Let me say that again. Their own number, nearly a full percentage point higher, in one quarter. At the same time, they revised GDP growth down. The first quarter just got finalized at 1.6%, down from the original 2.0 estimate. Economy slowing, prices rising. The Fed stuck between two bad options. Now, here's what happened to the dollar. The DXY, the US dollar index, broke above a critical technical level at 100.5. That level had been resistance for months. Once it broke, the dollar shot to 101, 13-month high. Here's why that matters for you. A huge number of institutional investors, hedge funds, commodity trading advisors, asset managers, were positioned for a weaker dollar. They had short positions. They were betting the dollar would fall. When the dollar broke out instead, those traders started getting squeezed. They have to buy dollars to close their losing positions. That buying pushes the dollar higher, which squeezes more shorts, which pushes it higher again. That's the crash up. It's not the dollar getting stronger because the economy is healthy. It's the dollar getting bid up because traders are trapped on the wrong side. And here's the thing most people miss about this. A gradual dollar rise is fine. Stocks and the dollar have risen together before. No problem. The risk is a sudden spike. A vertical move. Because the dollar is the foundation of global funding, every international loan, every trade settlement, every emerging market debt payment denominated in dollars. When dollars get scarce fast, it creates a liquidity crisis. People sell everything else, stocks, bonds, commodities, to raise dollars. That's happened before. 2008, 2018, March 2020. late 2022. So the signal I'm watching is not whether the dollar goes up, it's how fast it goes up. Right now, controlled. But the setup for acceleration is there. Now, here's where this gets really important for gold. There's a signal in the bond market right now that the financial media is almost completely ignoring. And when you see it, everything else I'm going to show you is going to click. It's the yield curve. Specifically, the spread between the 2-year Treasury yield and the 10-year Treasury yield. Right now, the 2-year yield is rising faster than the 10-year. That means the curve is flattening. And if it keeps going, it inverts, meaning the 2-year yield rises above the 10-year. Here's why that's the most important signal in all of finance. Banks borrow at short-term rates. They lend at long-term rates. The gap between those two rates is how banks make money. When short-term rates rise above long-term rates, lending becomes unprofitable. What do banks do when lending isn't profitable? They tighten credit standards. They approve fewer loans. They pull back. I watched this happen in real time. I was in the mortgage business when the curve inverted before 2008. Loan programs started disappearing. Guidelines tightened. Clients who would have been approved 6 months earlier were getting declined. Not because they changed, because the banks changed. That credit tightening is what actually slows the economy. Not the Fed raising rates directly. The banks transmitting those rates into the real economy by making it harder to borrow. And here's the pattern. Every major yield curve inversion in the last 40 years preceded a recession and a forced Fed reversal. Early 1990s recession, dot-com crash, the global financial crisis, the pandemic, the 2022 tightening cycle. Every single time, the curve inverted, credit tightened, the economy slowed, and the Fed was eventually forced to cut rates, regardless of what inflation was doing at the time. The market right now is pricing in more hawkishness. 9 of 19 Fed officials see a rate hike. The financial media is talking about higher for longer. But the yield curve is pricing in something different. It's pricing in the end of this cycle. It's saying this tightening will eventually break something, and the Fed will have to reverse course. That's the signal. And it's the same signal that has historically preceded gold's biggest moves. So here's where the dollar crash up and the yield curve converge on gold. I want to put 7 signals on screen, not opinions, data. And I want you to see them stacked together, because individually they're interesting. Together, they're the most constructive setup for gold in several years. Signal 1, seasonality. Over the past 20 years, gold has followed a consistent pattern. Rally early in the year, consolidate during the spring, pull back near the end of June, then strengthen during the second half. This year is following that pattern almost exactly. The consolidation started a little earlier, but we're right in the window where the seasonal turn typically begins. Signal 2, central bank demand. A recent World Gold Council survey found that 45% of the central banks surveyed expect to increase their gold reserves over the next 12 months. Let me put that in context. Central banks don't buy gold for a trade. They buy it for decades. That's structural, long-term demand sitting underneath this market. And it's accelerating. This is the fastest pace of central bank accumulation since the 1970s. Signal 3, speculative positioning is washed out. Professional money managers have reduced their net long exposure to gold significantly. The fast money has left the building. Now here's the contrarian logic. When professional positioning is this low, there are very few sellers left. And if the price starts moving higher, those same managers have to re-enter, which accelerates the move. Signal 4. Options traders are bearish at extremes. Demand for downside protection through put options has hit levels we haven't seen in years. Options traders are paying a premium to bet that gold goes lower. Historically, and I mean consistently, when bearish options positioning reaches this extreme, it creates the conditions for a sharp reversal. Because if gold rallies, all those put holders have to unwind their positions. That forced buying amplifies the move. Signal 5. Gold is underowned in ETFs. There's a relationship between gold ETF holdings and Federal Reserve policy expectations. Based on where rates are and where they're headed, ETF holdings should be significantly higher than they are today. That gap means institutional investors have not yet rebuilt meaningful gold exposure. When they do, and the yield curve is the catalyst that typically triggers it, the flows are significant. Signal 6. Fund managers are shifting sentiment. The percentage of professional fund managers describing gold as overvalued has fallen sharply. Similar shifts in sentiment appeared before the major gold rallies in 2017 to 2019 and 2021 to 2023. They're not bullish yet, but they're no longer bearish. And that transition from bearish to neutral is historically where the early positioning happens. Signal 7. The yield curve itself. This is the one that ties it all together. When the yield curve flattens or inverts, it signals that the Fed's tightening cycle is approaching its limit, that the economy will eventually slow enough to force rate cuts. And when rate cuts arrive, when real yields go negative, gold has outperformed cash in the following 12 to 24 months. Every time. Going back to the 1970s, 7 signals, all pointing in the same direction. None of them guarantees an immediate breakout, but stacked together, they tell you something important. Gold may be approaching one of its strongest macro setups in years. Now here's what I promised at the start. Both sides. Because if I only showed you the bullish case, I wouldn't be doing my job. The single largest risk to this thesis is the dollar. If the dollar crash up doesn't just confirm, if it accelerates into a sustained vertical rally, that puts direct pressure on gold. A strong dollar makes gold more expensive for international buyers. It can delay or suppress the entire second half setup I just described. So here's what I'm watching. If the dollar rises gradually, DXY drifting from 101 toward 103, 104 over weeks, gold can still build its base. The setup holds. If the dollar spikes vertically, DXY shoots past 104, 105 in a matter of days. That's a liquidity event. That's the short squeeze going nuclear. And in that environment, everything sells, gold included, at least initially. But here's the contrarian case for why the dollar breakout might fail. Wage growth is slowing, and wages are one of the most important drivers of inflation. When wage growth declines, consumers can't absorb price increases. Inflation falls naturally, without the Fed needing to hike. Historically, inflation has followed wage growth lower. If that pattern continues, the current CPI spike may be temporary, driven by energy and supply shocks, not by broad-based demand. The bond market seems to agree. Even though short-term yields rose after Warsh's hawkish comments, longer-term Treasury bonds have been strengthening. That means bond investors are betting on weaker growth and lower inflation ahead, not a sustained inflationary surge. If bonds are right, if wage growth keeps falling and inflation cools, then the dollar breakout becomes a bull trap. The dollar reverses, yields come down, and gold's second half setup activates even faster. I don't know which outcome wins. Nobody does. But I know the signals to watch, and I track them every single month. Which brings me to the last thing. Everything I just showed you, the dollar, the yield curve, the gold positioning, the PCE data, Warsh's framework, I track all of it inside the command center at timtalksfinance.com. The free tier, Fireside, gives you my monthly thesis, the 4 signals I watch, and the protection score that tells you where your money sits relative to the macro environment. The Command Center tier gives you the full market terminal, live data, the yield curve, the dollar, gold, treasuries, everything I put on screen today, updated and in one place. I built it because after the Inflation Ruler video, 71,000 of you watched that. The number one comment wasn't "great video." It was, "Where do I go to watch these signals myself?" This is where. Link is in the description. 2 minutes to set up, free to start, and all I ask is a quick thumbs up on the video, or if you really enjoy it, give us a hype. Here's the bottom line. The dollar crash up is real. It's confirming right now. And most people will look at a stronger dollar and think their savings are safe. They're not. Your savings account is earning 0.2% in real terms after inflation. 0.2%. And that number could go negative this Wednesday when the PCE data drops. The yield curve is telling you the Fed's hawkishness has an expiration date. And when that date arrives, when credit tightens enough, when the economy slows enough, when the Fed is finally forced to reverse, the rotation into hard assets begins. Gold is quietly building the setup for that rotation right now. Seasonality turning, central banks accumulating, speculators washed out, options traders on the wrong side, ETF investors underweight, fund managers shifting. 7 signals, same direction. I'm not telling you to buy gold today. I'm telling you to understand the mechanism so that when the move starts, you're not watching it happen from the wrong side of the trade. And I'm going to be tracking every signal between now and when it plays out. Subscribe so you don't miss a single update. Wednesday is the PCE report, the Fed's own preferred inflation gauge. If that number comes in hot, the stagflation trap deepens. If it comes in cool, the dollar breakout may be the bull trap the contrarians are calling for. Either way, I'll break it down. Hit subscribe. I publish these as fast as the data moves. And if you know someone sitting in a savings account right now, thinking they're safe because the dollar is strong, send them this video. That's the person who needs to see this. I'll see you in the next one.